In every age of investing, there comes a moment when the future looks so certain, so mathematically inevitable, that investors begin to stretch their horizons further and further ahead. They buy bonds that won't mature for decades. They load up on growth stocks that promise profits in some distant tomorrow. They tell themselves that patience will be rewarded, that time itself will ensure their returns. But Benjamin Graham, the man who taught the world what it truly means to invest, would have raised an eyebrow. Because to Graham, the danger was never just in being wrong about the future. The real danger was in being too confident about it. In this video, we'll explore why Benjamin Graham would question long-duration bets in today's market. We'll uncover what Graham saw as the silent peril of long-term projections, how even disciplined investors can be seduced by the illusion of certainty. You'll discover why Graham believed that time is not always the investor's ally, and how his timeless principles can help you protect your wealth in a world addicted to distant promises. So if you've ever wondered whether today's long-duration bond buyers and growth investors are echoing the same mistakes that Graham warned against nearly a century ago, stay with me, because this lesson might reshape how you think about time, risk, and value itself. To understand why Benjamin Graham would question today's long-duration bets, we must return to the markets of his own lifetime, an era when the word certainty often carried a cruel sense of irony. Graham began his investing career during the roaring 1920s, a decade when optimism was boundless and financial models seemed to prove that prosperity would last forever. Stocks soared on the assumption that the future was simply an extension of the present. Corporations issued bonds with maturities stretching decades ahead, and investors lined up to buy them, believing America had entered a permanent plateau of prosperity. Then came 1929. The crash wiped out not just fortunes, but faith. Investors who had bet on long-term growth, who believed the next 20 years were as predictable as the last 5, discovered that the market can rewrite the future overnight. Prices collapsed, dividends vanished, and once solid balance sheets disintegrated. Even the most respectable long-term holdings, railroads, industrials, utilities, fell by 80 or 90%. For Graham, this experience burned a single truth into memory. The future cannot be forecasted with precision, no matter how confident the models or persuasive the narrative. It's why he would later write, "The chief problem of the investor, and even more of the speculator, lies in the inability to sit still, in the compulsion to foresee and to act before the event." Graham emerged from the wreckage of the Great Depression with a new philosophy, one rooted not in prediction, but in protection. He came to believe that the longer one's investment thesis depended on distant forecasts, the more fragile it became. Fast forward to the post-war boom of the 1950s. Long-term government bonds traded near record lows in yield, just as they do today, while investors once again convinced themselves that stability was a given. Yet Graham, in The Intelligent Investor, urged caution. He warned that when investors accept low returns for long commitments, they are not demonstrating confidence, they are surrendering flexibility. He wrote, "The investor's chief problem, and even his worst enemy, is likely to be himself." For Graham, this didn't only mean emotional weakness, it meant intellectual overconfidence. The belief that one can safely extend into the future what has only been briefly observed in the present. Nearly a century later, we see the same movie playing again, only with faster actors, higher stakes, and far more zeros.
When Benjamin Graham spoke of the dangers of forecasting, he wasn't just warning against stock tips or economic predictions. He was pointing to a deeper illusion, the illusion of permanence in a world built on change. In today's financial language, a long-duration bet often refers to investments that depend heavily on assumptions far into the future, such as long-term bonds, high-growth stocks, or businesses priced on earnings that might not materialize for decades. These are positions where a small shift in expectations can erase years of projected returns. But Graham wouldn't have used the term duration in the modern mathematical sense. He would have thought of it more philosophically, as the distance between assumption and reality. The longer that distance, the greater the risk of disappointment. To Graham, investing was never about predicting what will happen, it was about preparing for what might. The longer your investment horizon stretches into an unknowable future, the more vital it becomes to build a margin of safety into every decision. This is why he drew such a firm line between investment and speculation. He defined the true investor as one whose decisions are justified by thorough analysis, promising safety of principle, and an adequate return. Everything else, including long-term bets based on hopes, trends, or extrapolated growth, he classified as speculation. So what does this mean in practice? It means that a portfolio filled with 30-year bonds at record low yields, or high-growth technology stocks trading at 50 or 100 times earnings, is not a mark of patience. It's a mark of misplaced confidence. It's the belief that the next 2 or 3 decades will unfold exactly as imagined today, without inflation surprises, interest rate reversals, or shifts in public sentiment. Graham would likely ask, what happens when that future fails to arrive on schedule? He understood that risk is not what you see, it's what you assume. And the longer your assumptions reach into time, the more invisible that risk becomes. Graham's teaching, therefore, was not anti-growth or anti-duration. It was anti-certainty. He believed that the investor's first responsibility was not to forecast returns, but to withstand mistakes. That is the essence of his philosophy. The intelligent investor does not try to profit from the future. He prepares to endure it. And that single principle, preparation over prediction, would completely change how we interpret the long-duration bets dominating today's markets. To understand how Benjamin Graham would approach today's long-duration bets, we have to look closely at how he actually managed risk across time. Graham never dismissed the idea of long-term investing. After all, value realization often requires patience. But patience, in his philosophy, was never blind faith. It was disciplined endurance, grounded in evidence and insulation from error. Graham's method always began with a realistic appraisal of what could be known and a deliberate skepticism toward what could not. In his own words, the future itself can be approached only by the way of the past. That statement may seem obvious, but it carried profound weight. Graham meant that the only foundation worthy of an investor's confidence was historical fact, not theoretical promise. When he analyzed bonds, for example, Graham emphasized the ability to pay, not the intention to pay. He judged long-term bonds by the issuing entity's proven earning power, the stability of its past results, and its resilience during prior economic contractions. To him, a 30-year bond was not a prediction. It was a test of the borrower's durability through adversity. And when he turned to stocks, the same logic applied. In security analysis, Graham cautioned that valuing equities based on the future earning power was fraught with illusion unless it was anchored in the company's demonstrated performance. The further investors projected beyond what had been proven, the less reliable their estimates became.
His antidote to this uncertainty was what he famously called the margin of safety, the buffer between price and value that protects investors from the inevitable surprises of time. It was, in essence, a refusal to bet one's fortune on the perfection of one's own foresight. Consider how Graham and his partner, David Dodd, viewed long-term bonds during periods of low interest rates. In the 1930s, when bond yields had fallen and investors believed they were entering a new era of permanent stability, Graham wrote with gentle irony that the enthusiasm for long-term commitments at low rates has often been a prelude to regret. He saw that as rates eventually rise or inflation reappears, those locked into low-yielding, long-duration assets suffer the most. That warning resonates profoundly today. When investors lock capital into assets priced for perfection, whether that's a 30-year treasury bond yielding 2% or a tech company valued on profits 2 decades away, they are not practicing patience, they are practicing presumption. Graham's method for avoiding that trap was beautifully simple. 1. Anchor every estimate to verifiable data, not speculative forecasts. 2. Refuse to extrapolate the recent past into the distant future. 3. Demand a wide margin of safety when assumptions stretch over long horizons. These were not merely analytical rules, they were ethical ones. They expressed a moral humility about what investors can truly know. Graham did not seek to predict the future, he sought to be unharmed by it. And that single distinction between prediction and protection is precisely what separates the disciplined investor from the speculator in his era and ours. If Benjamin Graham were observing today's financial landscape, he would likely be both fascinated and uneasy. The technologies, products, and platforms have changed, but the human patterns beneath them remain astonishingly familiar. The world may speak the language of data, algorithms, and innovation, yet beneath it all beats the same old speculative heart. Today's markets are filled with what Graham might have called long-duration illusions. Investors commit enormous sums to companies or assets that promise earnings far into the future, often 10, 20, or even 30 years out. The assumption is that the future will unfold neatly along the optimistic projections embedded in their models. Whether it's high-growth technology stocks, venture-backed startups, or even long-term government bonds, the same psychology prevails: the belief that the future can be tamed by narrative and discounted into certainty. But Graham would have asked a quiet, piercing question. What are these assumptions built upon? When interest rates remain low for too long, markets develop what he called a false sense of permanence. Investors begin to think that the conditions of the recent past, cheap money, stable growth, abundant liquidity, will stretch indefinitely into the future. They price assets as though time itself has lost its ability to surprise them. And then, inevitably, the surprise arrives. A shift in inflation expectations, a tightening of credit, a geopolitical event that ripples across markets. Suddenly, what once looked like patient conviction now looks like reckless optimism stretched too thin across too many years. This is exactly the pattern Graham saw in the speculative booms of the late 1920s, and decades later, echoed in subsequent manias, from the Nifty 50 stocks of the 1960s to the dot-com bubble of the late 1990s. Each time, investors convinced themselves that they were being long-term thinkers, when in fact they were simply long-term believers. In Graham's framework, true long-term investing requires evidence of enduring earning power, tested through adversity. Speculation, by contrast, builds castles of expectation upon sand, relying on the assumption that growth and sentiment will continue unbroken across decades.
Consider how this applies to today's most celebrated growth companies. Many are priced at multiples that assume flawless execution, uninterrupted innovation, and constant market dominance for 20 or 30 years. Yet, as Graham would note, the chief problem of the investor, and even more so of the speculator, lies in his susceptibility to emotion. When optimism becomes an anchor rather than a guide, it blinds judgment. Or take another modern parallel, the phenomenon of duration risk in fixed income markets. For years, ultra-low interest rates made long-term bonds appear safe and reliable. Investors seeking yield extended duration, often far beyond what Graham would have considered prudent. When inflation returned and rates rose, the supposedly safe portfolios suffered massive unrealized losses. Graham would not have been surprised. In fact, he wrote that the most dangerous time for investors is often when the world feels most stable. The chief cause of failure is that people give way to emotion instead of reason, he reminded his readers. In our time, the emotional impulse is rarely fear of loss. It is fear of missing out. The investor who buys a stock at 1,000 times earnings or a bond yielding 2% for 30 years is not driven by logic, but by a quiet anxiety. What is this opportunity leaves without me? Yet, as Graham would remind us, the market always rewards those who can separate time from timing. Being long-term does not mean believing farther into the future. It means enduring wisely through it. In today's financial climate, where AI models project endless growth and financial media glorify decade-long compounding, Graham's humility feels almost radical. He would urge investors to question every assumption that extends beyond the horizon of evidence. He would remind them that forecasts, no matter how sophisticated, cannot eliminate uncertainty. They can only disguise it. And most importantly, he would reassert that investing is not the art of knowing the future, but the discipline of preparing for it. Calmly, skeptically, and with a margin of safety wide enough to absorb the world's inevitable surprises. Benjamin Graham's conservatism was not born from fear, but from humility. He understood something that modern investors, armed with data and confidence, often forget: that time is both the investor's greatest ally and his most unforgiving judge. Graham's reflections on time were not mathematical. They were deeply philosophical. He saw that investors do not merely project numbers into the future, they project themselves, their hopes, their confidence, their rationalizations. And in doing so, they mistake the continuity of optimism for the stability of truth. To Graham, conservatism was not about avoiding opportunity, it was about recognizing human limitation. He once wrote that the intelligent investor must be prepared for either outcome, success or disappointment, without being unduly affected by either. In those few words lies a lifetime's wisdom, that time does not reward certainty, but character.
When you think about long-duration bets, you are really thinking about the future. And the future, in Graham's mind, was not an investment frontier. It was a psychological mirror. It reflected the investor's temperament more than it revealed any knowable truth. He believed that human beings have a natural desire to escape the present. When the present feels uncertain, we retreat into the future, the only place where things can be as perfect as we imagine them. This is why markets always overprice promise and underprice patience. The distant future feels safer because it is untested. And yet, Graham would say, it is precisely the untested that is most dangerous. In the quiet logic of his philosophy, every projection beyond the reach of evidence was a form of speculation, even if dressed in the language of prudence. He might have quoted the old Latin phrase, tempus edax rerum, time devours all things. The earnings forecasts, the discounted cash flows, the bullish narratives, all are subject to time's quiet erosion. What endures is not prediction, but principle. For Graham, this principle was embodied in three virtues: rationality, restraint, and realism. Rationality demands that we see markets not as prophets of the future, but as reflections of the present mood. Restraint reminds us that even intelligence becomes self-destructive when untempered by humility. And realism teaches us to separate what we wish to happen from what we can reasonably depend upon. In his world, as in ours, the real challenge in investing was never about understanding numbers. It was about understanding oneself. Because the market, Graham believed, is not moved by valuation models, but by human nature repeating its oldest habits under new disguises.
He might look at today's financial optimism, at investors buying 30-year assets with the certainty of profits, and smile gently, not with contempt, but with compassion, because he knew how powerful the illusion of control can be. To him, the conservative investor was not a pessimist. He was simply aware that the line between long-term vision and long-term delusion is drawn not by time, but by evidence. The farther you extend beyond evidence, the closer you drift toward speculation. And this is perhaps Graham's most enduring philosophical gift, that he taught us to redefine what it means to be optimistic. To him, optimism was not believing that the future will be kind. It was believing that reason will prevail, even when the world forgets it. In that light, his conservatism becomes something more profound than a financial strategy. It becomes a moral stance, a quiet resistance to the arrogance of prediction. Because while the world rushes to forecast tomorrow, Graham's voice reminds us to understand today, to look not for comfort in time's passing, but for clarity in time's testing, to anchor our confidence not in what might be earned, but in what can be endured. And that is where his true wisdom lies, in showing that every investor's greatest advantage is not foresight, but self-control. Benjamin Graham's conservatism is often misunderstood as mere caution, as if he were telling investors to avoid risk altogether. But Graham's true message was not to avoid risk, but to respect it. He wanted investors to recognize that the future is never something we can own. It's only something we can prepare for. In today's markets, that preparation begins with humility, the one trait technology and confidence seem to have quietly erased. Graham would remind us that the sophistication of our tools does not guarantee the soundness of our judgment. The investor's task then is not to predict how long-term trends will unfold, but to construct a portfolio that does not depend on prediction to survive. That was the essence of his conservatism. The idea that endurance is the highest form of intelligence in investing.
So how does this apply to us in an age where investors build portfolios with 30 and 50-year horizons, where pension funds rely on low discount rates, and where the faith in growth seems almost absolute? Graham would start, as he always did, with the distinction between investment and speculation. He would ask, is this position justified by present facts or only by hopes about the future? That single question, simple yet surgical, can transform the way an investor sees the world. If an investment's worth depends entirely on things staying perfect for decades, low inflation, steady rates, constant innovation, then it isn't a margin of safety, it's a margin of faith. And faith, Graham knew, belongs in philosophy, not finance. He would urge the modern investor to shorten the reach of their assumptions, to build margins not in forecasts, but in balance sheets, to find comfort not in momentum, but in valuation, to anchor expectations not in trends, but in temperance. The true conservative investor in Graham's philosophy is not one who avoids risk, but one who refuses to pretend that risk has disappeared. He might suggest 3 timeless principles for navigating today's long-duration market illusions. 1. Demand reality over story. Graham believed that every sound investment must have its justification in measurable facts. If the investment story depends on assumptions 10 years away, those are not facts, they're fiction with numbers. 2. Let price discipline belief. No matter how compelling the narrative, the price you pay determines your return. When the market offers the best companies at the highest prices, the intelligent investor steps back. Graham would rather miss a rally than fund a fantasy. 3. Protect yourself
from yourself. In an age of complex models and instant forecasts, Graham would say that the greatest danger still lies within, in the desire to believe that this time is different. His conservatism was not about mistrusting the world, but about understanding one's own mind. And perhaps that's why his ideas still breathe truth into an era ruled by abstraction, because while markets change, human nature does not. We still chase certainty. We still confuse motion with progress. We still think that more information means more wisdom. But Graham knew the opposite was true, that wisdom often begins where prediction ends. He would likely advise today's investors to build portfolios the way a craftsman builds a bridge, not to survive perfect weather, but to endure the storm, to choose strength over speed, to prefer resilience to reach, to remember that in the long run, survival is the highest return of all. And that is the essence of Graham's quiet genius. He showed us that the investor's real battle is not against the market, but against time, and against the illusions that time creates. In a world obsessed with what the next decade will bring, Graham invites us to focus on something far rarer, the ability to remain rational when others lose their balance.
He would say, you don't need to know the future to succeed. You only need to avoid destroying yourself before it arrives. So the next time you hear predictions of 30-year trends, of unending growth, of safe, long-term bets built on faith and permanence, pause. Remember that Graham's greatest lesson was not how to value a company, but how to value judgment. Because markets will always be driven by confidence, and confidence will always overreach. But rationality, calm, disciplined, unhurried, is the only edge that time cannot erode. And so, as we close, let's return to Graham's own quiet reminder. The essence of investment management is the management of risks, not the management of returns. That single line, delivered nearly a century ago, may be the most important guidepost for the modern investor, because it tells us that our success does not depend on how far we reach, but on how firmly we stand. To think independently, to question optimism that has no foundation, to protect capital before seeking gain, and to remember that in the long run, value is not measured by price, but by permanence. So as markets stretch the future farther and farther ahead, remember Graham's warning. The longer the promise, the greater the patience it demands, and the smaller the certainty it deserves. And perhaps that's what makes his wisdom so timeless, because even in a world that worships the next decade, Benjamin Graham still teaches us how to survive the next day. Subscribe and join us in keeping Benjamin Graham's wisdom alive, one lesson at a time, for a world that still needs rational investing.